Welcome to the week that was. Wow. I mean, the digital asset market just went through one of the most violent periods we've seen in a while.
Yeah, absolutely. A huge crash, then this like instant powerful rebound.
And then just this grinding slide down that wiped out hundreds of billions from the total market cap, just gone.
And that volatility, it wasn't just crypto being crypto. This was really different. It was a proper stress test driven by external macroeconomic risk hitting a system that was, frankly, pretty highly leveraged before this.
Okay.
So our mission today really is to look past those immediate price swings, the charts everyone stares at, and understand what this volatility actually cleansed from the market.
Right.
And maybe more importantly, where's the real structural capital flowing now?
Yeah.
Because we definitely saw a historic deleveraging event, no question.
Mm-hmm.
But the big question for you listening in is, did this create a stronger, maybe safer foundation? Or did it just expose some, deeper fault lines?
Okay, yeah, let's definitely unpack that because the core tension here, I think, for this deep dive is all this conflicting data we're seeing.
Exactly.
On one hand, you've got confirmation of record institutional selling, but it feels tactical. And then on the other hand, you see sovereign wealth funds, even whole nations, building like core national ID infrastructure on public blockchains.
The real battle, isn't it? Short-term fear versus that long-term strategic conviction.
So we really have to start with the trigger, the specific geopolitical thing that kicked off the chaos last week, the tariff shock.
Yeah, that's the ignition point. The immediate panic selling we saw, that was a direct, you could almost measure it, response to those escalating U.S. China trade tensions.
Specifically, the threat of those 100% tariffs.
Precisely, the really big ones. And that led to this deep, super rapid plunge. Bitcoin actually dipped below $105,000, just briefly.
And the consequence of that drop was that classic cascade in the derivatives market, right?
Oh, yeah. It was a massive purge, a textbook deleverage event, really. We saw numbers like over $19 billion in, let's call it speculative excess, just liquidated.
Wow.
Mostly through a long squeeze. So for anyone maybe not familiar, a long squeeze is when you have too many traders leveraged up, betting the price goes higher.
Mm-hmm.
And then the price drops sharply. Exchanges automatically sell their collateral to cover the losses, which pushes the price down even more. It's a vicious cycle.
And that's what cleared out the excess leverage.
A liquidation cycle, yeah. That's what cleared it.
Now, in some of the analysis we looked at, you called it a healthy reset, particularly looking at the derivatives market.
Mm-hmm.
But, for the listener who just saw $19 billion vanish instantly, it probably felt pretty devastating. So how can we really call that healthy? Didn't it just expose how fragile things were?
That's a really fair point.
Right.
It's healthy, not because it wasn't painful, it absolutely was, but because it eliminated a specific kind of risk.
Yeah.
The internal risk.
Oh.
See, before the crash, those derivatives funding rates, they were dangerously high. Speculators were paying a big premium just to hold those leveraged long positions.
Right.
After the crash, those rates just plummeted, went to neutral, sometimes even slightly negative. So that means the intense concentration of risk driven purely by leverage, that's been cleared out, for now at least.
So price discovery now is more about actual buying and selling.
Exactly. It's being driven more by fundamental spot dynamics, people trading actual coins, not just betting on futures contracts.
Okay, so the slate was wiped clean internally, but then,
yeah, that clean slate was immediately overshadowed because the price action since the crash, it's been almost entirely dictated by U.S. China headlines, just back and forth.
Right.
And this is where that external macro risk just takes over. It becomes the main driver.
We did see that little bounce initially, didn't we? Some conciliatory talk.
We did. A brief moment of hope.
Yeah.
But hopes for a quick fix faded really fast.
Because the conflict escalated.
It escalated quickly.
Yeah.
It moved beyond just a standard trade war, tariffs and taxes, into something analysts are now calling a structural supply chain siege.
A siege? That sounds serious.
It is. China retaliated with actual sanctions, tit-for-tat port fees. They moved beyond just talk into actions that interfere with the physical movement of goods. And that uncertainty, this growing idea that the world's two biggest economies might actually be structurally decoupling, well, that led to repeated grinding selling pressure. That's what pushed Bitcoin down to that 5.5-month low, around $103,566.
And we actually have data confirming that structural shift, don't we?
We do. Official trade data came out showing Chinese exports to the U.S. fell, get this, by 27% year over year in September.
27%?
Yeah. So that confirms this isn't just political noise. A real substantial structural decoupling is happening, and global risk assets, crypto included, are reacting to that reality.
But here's where the story takes another sharp turn, right? Just as that fear seemed to be peaking.
Exactly. A massive macro tailwind suddenly appeared. China and the U.S. agreed to get back to the table, resuming high-level trade talks.
And the market reaction was immediate.
Instant relief. Now, analysts actually have a cynical term for this pattern, where markets get whipsawed by these big threats that then suddenly get walked back.
Yes, the taco strategy.
The Trump always chickens out, or taco strategy, yes.
Yeah.
Now, the important thing here isn't the political commentary itself, but recognizing that analysts identify this as a trading pattern for global risk assets.
Right.
Markets get jerked from panic straight back to reversal very, very quickly based on these shifts.
Okay, so if the daily charts are showing panic driven by macro headlines, let's zoom out again. How did the longer term, maybe the fiduciary capital react? Let's talk institutional money, because on the surface, the story seems pretty bad, right? Coordinated panic selling via the ETFs.
Yeah, the tactical outflow picture is it's undeniable. We saw the first ever synchronized net outflow across all the U.S. spot Bitcoin ETFs on a single day.
All of them.
It went.
At once.
All of them. Totaled $530.9 million out in one day. And for that whole volatile week, the total net outflow was $1.225 billion.
$1.2 billion. That's just huge volume. And that included BlackRock's IBIT, didn't it? The one everyone thought was the bedrock buyer?
It did. IBIT itself recorded a single-day net outflow of $268.6 million. That really challenges the narrative, doesn't it? The idea that this ETF capital was this unwavering strategic buyer of last resort.
Yeah, it suggests a big chunk of it is actually pretty tactical, very sensitive to headlines.
Highly tactical, exactly.
So, okay, we have $1.2 billion in confirmed institutional fear leaving the market. But you're saying this is being countered by strategic conviction coming in. Is the conviction volume just being swamped by the fear volume right now?
In the short term, looking purely at those flow numbers, yes, the outflows are bigger right now, but strategic capital isn't really measured by its speed, is it? It's measured by the depth of commitment.
Okay, so where is that strategic money showing up?
Well, look at a few key areas. First, fiduciary commitment. We saw Florida lawmakers introduce Proposal HB 183.
Right, the pension fund proposal.
Exactly. It would authorize state and pension funds, including the massive Florida Retirement System's trust fund, to potentially invest up to 10% of their portfolios in digital assets.
Just pause on that. 10% of Florida's pension fund? I mean, that's not a trade. That's a generational allocation decision.
It's a massive potential shift. And we're seeing interesting corporate strategies pop up, too.
Like Harrison Global.
Yep. NASDAQ-listed Harrison Global announced a specific Bitcoin treasury strategy. And then you have this kind of incredible example. NYSE-listed Newsmax Inc.
Oh, the Newsmax one, yeah.
They authorized buying up to $5 billion in Bitcoin and the meme token Trump coin.
Right. A corporate treasury holding Bitcoin and a meme coin side by side.
It perfectly captures the weird contradictory moment we're in, doesn't it?
Yeah.
Serious finance meets high conviction novelty.
It really does. And then on the infrastructure side, that Ripple acquisition seemed pretty significant.
Oh, the G Treasury deal. Yeah, that's huge. Ripple paying $1 billion for a corporate treasury management system.
What's the play there?
It's about embedding digital assets directly into the plumbing of traditional finance. Specifically, integrating them into real-time cross-border payments. We're talking about a system that handles like $12.5 trillion in annual payment volume.
So building the bridges.
Building the bridges, exactly. That's deep strategic integration. Tactical sellers pulling out of ETFs, they can't undo that kind of structural work.
Okay, so the money flows are complex. What about the tech itself? How did the underlying infrastructure handle this intense volatility? It was a real stress test for the whole ecosystem, wasn't it?
It really was, and it exposed a pretty stark divide, actually.
Between centralized and decentralized.
Exactly. On the centralized side, we saw issues. Major exchanges, Binance, Coinbase, they reported operational problems, frozen accounts, degraded performance.
And Binance had that stablecoin issue.
Critically, yes.
Yes.
Binance had to pay out $283 million in compensation to users who got hit by stablecoins de-anchoring during the chaos. That's a single point of failure.
Yeah, but the decentralized side, DeFi.
That's where the validation came in. Core DeFi protocols. They performed, basically, flawlessly.
Really? Under that pressure?
Yeah. Uniswap, the decentralized exchange, processed nearly $9 billion in volume, no downtime. And Aave, the lending protocol, automatically liquidated a record $180 million in collateral in just 1 hour. executed its code exactly as programmed.
Wow.
That's not just robustness.
Wow.
That's a massive real-world validation of autonomous code-as-law systems operating under billions of dollars of stress.
Okay, so that's structural resilience combined with the strategic capital inflows we talked about. It really underlines that the global adoption story seems completely decoupled from these wild short-term price swings.
Totally decoupled. The long-term utility case is just pushing ahead, regardless of the daily charts. I mean, look at national adoption. The Kingdom of Bhutan announced they're migrating their entire national digital ID system
For all their citizens.
for 800,000 citizens, yeah.
Huh.
Migrating it onto the public Ethereum blockchain. That's core national infrastructure being built on a public network. That's huge.
And what about securing the asset itself long-term? Any progress there?
Actually, yes, a major milestone just this week. BTQ Technologies demonstrated the first quantum-resistant Bitcoin implementation.
Quantum resistant, how does that work?
Basically, they successfully swapped out the current cryptographic signature algorithm, ECBSA, which could theoretically be vulnerable to future quantum computers,
Okay.
and replaced it with a NIST-approved quantum-safe algorithm. This massively de-risks Bitcoin's long-term security profile, especially against that theoretical quantum threat. That's a huge deal for institutional allocators thinking decades ahead.
Got it. And we also saw more regulated pathways opening up, right? Making it easier for traditional finance to connect.
We did. Telcoin raised $25 million specifically to meet the requirements for launching the U.S.'s first regulated blockchain bank charter.
A blockchain bank charter.
Yeah. It's a framework that explicitly authorizes connecting traditional bank customers directly to DeFi protocols, but within a compliant structure. And then, maybe just as importantly, the SEC approved the Form 8A for the 21 shares Solana ETF.
Ah, so moving beyond Bitcoin and Ethereum ETFs.
Exactly. It sets a regulatory precedent for institutional products targeting other major crypto assets. Opens the door.
Okay, so let's try and bring this all together. We've got geopolitical uncertainty kind of neutralized for now, strategic commitments surging, infrastructure proving resilient. But what does it all mean for the price right now? Where are we on the technical chart?
Well, right now, the market is in a fierce battle. It's fighting for control of a really critical support zone. Think between roughly $106,000 and $107,000.
Why is that zone so important?
Because it contains the 200-day simple moving average. That's a technical level that many traders see as the dividing line, basically, between a bull market structure and a bear market structure. Failing to hold this level decisively, that signals trouble ahead, technically speaking.
And what needs to happen for the bulls to regain control, to get some momentum back?
Buyers really need to push price back up and decisively reclaim the immediate resistance zone. That's sitting around $109,000 to $110,000.
Okay. And sentiment right now feels pretty negative.
Oh, it's definitely pessimistic.
Yeah.
You can see it in the crypto fear and greed index. Yeah. It hit its lowest point since back in April, deep in the extreme fear category.
So that tactical capital we talked about, clearly running scared.
It absolutely is. But, and this is the crucial contrarian signal, on-chain data paints a different picture below the surface.
How so?
It shows that smaller holders, the non-ETF guys, wallets holding between, say, 1 to 1,000 Bitcoin, they are actively buying the dip.
Ah, absorbing the ETF selling.
Exactly. They're absorbing the supply being sold off by those nervous, highly tactical ETF investors. So it suggests coins are actually moving from these shorter-term, maybe weaker hands into the wallets of more fiduciary-minded accumulators, people with a multi-year view.
Okay, so let's try and summarize this really chaotic week.
Yeah, I think the market right now is defined by this deep structural tension. On one side, the specific macro trigger for the crash, that trade war escalation, it seems to have been neutralized, at least temporarily, by the talks resuming. But on the other side, a significant chunk of the institutional capital that fueled the recent rally, that's been tactically pulled off the table. We see that clearly in the record ETF outflows.
So that's really the key takeaway for you listening. The short-term picture, it looks uncertain, maybe even bearish, because of that technical damage and those big tactical outflows.
Definitely messy short-term.
But the long-term fundamentals, things like Bhutan's national ID system on Ethereum, the quantum resistance upgrade for Bitcoin, that massive pension fund interest bubbling up, arguably, they've never looked stronger.
Right.
So this current price weakness feels fundamentally like a transfer of supply away from those risk-averse tactical players and into the hands of conviction-driven long-term strategic holders.
Well said. And, that leads us perfectly into the final provocative thought we wanted to leave you with this week.
Okay.
Think about this. During the absolute peak of the risk-off panic selling this week, what happened to traditional gold?
It soared, right. Record highs for futures.
Exactly, it soared, demonstrating that, for now, big institutional capital still defaults to gold as the primary defensive hedge in a crisis.
Right.
So, given the structural de-risking Bitcoin is undergoing, making itself quantum-resistant, building these regulated bridges to DeFi, the real question becomes, if Bitcoin manages to stabilize here and the macro environment kind of settles down, will institutional capital eventually face a choice?
A choice between gold and Bitcoin.
A choice between gold, the historical safe haven, and this newly hardened digital asset with a globally defined strategic reserve narrative. That potential divergence, that potential shift in perception, that's something really significant for you to mull over in the weeks and months ahead.